All right, welcome everybody to another video on the After Hours channel. As you can see, we're doing things a bit different. Finally figured out the camera situation, so I'll be including that in all of the future videos. As for the background, I'll be fixing that in the future and really putting my office together. But as of right now, let's focus on what actually matters and why you probably clicked this video. And that is the portfolio update. As you guys can see on your screen right here, portfolio is sitting at $111,000. That's real money. And it is down 0.25% today, or $273. Now, going forward for this video, we're going to add something new. In addition to the portfolio update, letting you guys know my buys and sells and recent trades and dividends, I also want to highlight the questions that I get in the comment section. So for this video, very first time, I'll be highlighting one of the recent comments that I received, and we'll be answering that from my personal perspective. To end things off, we'll be taking a look at some of my holdings, some of the companies that I own, and doing an overview of their analytics. If you guys have any questions for it, or you want your comment to be published on this channel in the next video, leave a comment down below. And if you find any of the information in these videos useful, you guys know what to do. Without further ado, let's kick this thing off. So, like I said, portfolio's at $111,000. We'll take a look at the 1 week view. 1 week view, pretty much flat. Let's take a look at the 1 month view. 1 month view, portfolio you can see has actually been hurt quite a bit. Portfolio is down 6%, or $7,200. Moving on, let's take a look at the year to date, because on this channel, I'm all about transparency. I'm not trying to hide my losses from you guys. I want to show you what it's like to be an actual investor. The market goes down. You will lose money sometimes, but unless you actually sell those assets, those holdings that you have, you don't lock in these losses. Year to date, the portfolio is down 13.1%, or $16,000, almost $17,000. There's been quite a few dips in the market over the last year, as I'm sure you guys have experienced as well. This thing has consistently gone down. Now, you guys may be thinking this guy is down nearly $17,000 in a year, or 13%. He doesn't know what he's talking about. Let's compare my portfolio year to date to the S&P 500. Taking a look at the 1 year view for the S&P 500, because it is January 2nd, so we don't have that year to date information anymore. The S&P 500 is down 20%. Compare that 20% to my 13%, and I like to think that I am doing pretty well. Now, do not get it mistaken. I'm not bragging about being down $17,000 in a year, but again, I want to highlight to you guys that this is normal. There are fluctuations in the market. It's not always going to go up. Currently, there's a lot of bad news on the horizon. Therefore, the market has consistently gone down. In addition to that, inflation has not helped the market, and the Fed printing money. I highlight these drops in the market not to invoke fear or scare you guys, but to show you the reality of investing. This is what it looks like sometimes. As I mentioned in a previous video, if you guys want to enjoy the bull markets and the gains, you sometimes have to suffer through the bear markets, which we're currently in right now. Shout out to Mike Vick for being the first subscriber to start this new segment off. All right, let's take a look at what Mike said. He said, "Hey dude, really enjoy the content and would like to know what you think of a buy I'm considering. I'm thinking of buying LI Bank as it has many of the things that you and me like to see in a company, and I really like the price. Anyway, subscribed, look forward to seeing updates." Well, thank you, Mike. I really appreciate that. And to answer your question, I want to look at Ally Financial's analytics, take an overview of the company, and there's a few other things I want to highlight. Jumping into Ally Financial, ticker symbol ALLY. First and foremost, let's start here at the top. So PE for LI is essentially 4, forward PE 4.9. This is pretty high for banks. PE ratio is different for financial compared to, let's say, consumer brands. So that's definitely one thing you want to keep an eye out for. Moving over a little bit, I like to see that their cash on hand, their cash on hand, 31 billion in comparison to 13 billion in debt. So that's definitely something that I like to see. As I am a dividend investor, you can see right here that they pay a 4.9% yield, which is pretty high. Moving down, let's take a look at their revenue. Revenue since, call it 2007, looks like has consistently gone down and stayed flat. this is definitely not something that I want to see in a company that I'm investing in. So for Mike, this would probably be my first red flag, in addition to their PE ratio being pretty high for a bank. Let's take a look at their EBITDA. Pretty much resembles their revenue. So again, not something I want to see. We'll call that red flag number 2. As for free cash flow, it looks like it's been pretty flat over the years. I mean, if not flat, it's been in the negative since 2010. Again, this is not something I want to see, but let's also take a look at their stock-based compensation to see how much they're paying their executives in comparison to how much money they're making. When we take a look at the stock-based compensation, it's virtually non-existent. So free cash flow doesn't look good. In 2021, they actually lost $1 billion. So that's another red flag for me. But I guess as far as stock-based compensation goes, they're doing pretty well. Scrolling down a little bit, let's take a look at their dividend because this is a dividend portfolio. Their dividend looks pretty good. Since 2016, they've raised their dividend, looks like in the last 5 years, by 20%. That's a pretty good jump. I would take that. As of right now, it looks like their current dividend is paying 30 cents. As far as green flags go, this would probably be my first green flag for the company. They are paying a consistent dividend, though it's not a long enough history for me to really think this is an attractive company that I would want to buy into. Most of the companies in my portfolio have been paying a dividend for 20 years, 30 years, 40 years, and in some cases, 50 years. Let's take a look at their outstanding shares. So this is definitely something you want to see. Since 2015, it actually looks like they've been doing stock buybacks, which is definitely a green flag for me. Let's take a look at the last decade real quick, and we can see that they did quite a bit of dilution. 2004, they issued new shares, and in 2013, they issued new shares. Now they're buying them back now, but this is kind of a red flag for me if the company consistently switches back and forth from issuing new shares to buying their own shares back. I like to see a consistent share decrease. Therefore, I'm not getting diluted as the shareholder. Moving on from an overview of the financials of the company, there's one thing I want to take a look at, and that is the used car market. You may be wondering, if we're looking at Ally Financial, it's a bank, why are we looking at the used car market? To answer that question, click right over here. We can see that Ally is the largest auto lender by volume in the United States. That is incredibly important when you're looking at this as an investment. As we can see, the used car market has been on a steep decline in recent years. This gives me hesitancy when investing in this company. If people can't pay off their auto loans and they stop making payments, that means Ally's revenue is going to drop over time, or it's going to consistently drop, and their free cash flow is also going to drop. Short answer, I want to invest in companies that have consistent compounding effects, and I believe that Ally Financial is too levered in the used car market. Therefore, I think I'd be taking too much of a risk in that investment. Now, this isn't to say that this is a bad investment. I could be completely wrong about this, and it could skyrocket in the next 5 years. But with that being said, I will say to do your own research and make your own financial decisions if you are going to invest in this. Taking a look at my recent trades, you guys can see that I have 5 upcoming buys. Coming in at number 1, and that's $1,000 buy of SCHD. Coming in at number 2, and that is Microsoft. I'll be buying $250 more of Microsoft. As I spoke about in the last video, Microsoft is actually my largest holding by far. That is the company that I have the most conviction in. If you want me to do a deep dive into Microsoft, let me know, leave a comment down below. Third buy on the list, and that is Vici Properties for $250. Number 4 should not come as a surprise. I spoke about it in my last 2 videos, and that is another buy of Union Pacific for $250. And lastly, to end things, I am also buying $268 of Starbucks. Moving on, let's take a look at the overview of Starbucks and Union Pacific. So currently trading at $100 per share. PE is 35, forward PE 30, so pretty expensive for this company right now, in my opinion. As for the 1-year view, Starbucks is currently down 15%, so much less than other companies. So I wouldn't say it's the best buy in the market, but it is a company that I have a large conviction in. Let's take a look at the revenue, and as you can see, it is consistently going up every year. In the last year, they increased their revenue by 11%. In the last 10 years, they increased their revenue by 9%. As for free cash flow, it's not the most consistent thing to look at, but when we compare that to their stock-based compensation and how much money they're earning, we can see that in this blue graph right here, they paid their executives essentially $300 million in comparison to the $2.5 billion that they made. So relatively low, and it doesn't look like it's increasing too much over time. Starbucks is a consistent dividend payer, and they have been increasing their dividend over the last 10 years. As you can see right down here, 17%. In the last year, they increased their dividend by 8.1%. This is something I definitely look at when I am investing in my companies, because not only do I want the shares to appreciate in order to make money, but when they increase their dividend, I'm also increasing my income. Lastly, let's take a look at something called return on capital employed. Now, to break this down in layman's terms, this is how much money the company invests and how much they get in return for those investments. So let's say in 2022, they invested $100. Well, they made $125 off of that. Typically, companies will have a return on capital employed percentage around 10%. That's usually the average. As we can see here, Starbucks has consistently a high return on capital employed, even in the lower months being 14%. Some years we can see it's actually above 40%, which is extremely high for any company. Moving on, let's take a look at Union Pacific. It's trading at $207 right now with a PE ratio of 18.4 and a forward PE of 17. So I would say it's relatively fair value, if not cheap at this point. As for the revenue, we can see that they increased their revenue by 11.6% in the last year, and in the last 10 years, 1%. As for their EBITDA, it's consistently gone up over the years, which is something that you definitely want to see. This is a green flag. Since 2007, they've increased their free cash flow consistently. This is unlike many other companies you will see. In some respects, this is actually better than some of the major tech companies out there. So this is incredible. As we did on the previous companies, let's take a look at their stock-based compensation in comparison to their free cash flow. As you can see, virtually non-existent. This essentially means that they are not diluting shareholders by paying their executives huge bonuses. Outstanding shares have decreased rapidly over the last 10 years, and their dividend payments have consistently gone up. This is exactly what I want to see in my companies. Lastly, let's take a look at the return on capital employed, just like we did with Starbucks. And you can see for a railroad company, their return on capital employed is quite well. They average around 14 to 15%, which in their occupation and their business is quite good. Switching gears a little bit, let's take a look at my recent dividends. You can see them right here. JEPI, which is a JP Morgan ETF, will be paying me $34. And Vici Properties, which I talked about in my last two videos, is going to be paying me $71. If you're curious what JEPI is, it's an actively managed ETF that actually gives you exposure to options trading. The overall goal of this ETF is to outperform the S&P 500, but also maintain lower volatility. Now, in addition, they also pay a very high monthly dividend yield of 6.3%. Now, this may change, it may fluctuate, it may go up or down, but from what I've seen owning this stock for like the last year, it stays around this 6%. If you guys have a question about anything that I covered today, whether it be some of my holdings, some of the companies that we did an overview of, or JEPI that we just covered at the end, please let me know in the comment section. With that being said, that's going to conclude episode 3 of Road to 1 Million. So I appreciate you guys watching. Take care.